big group, but most people on the call today are existing clients. So just a general disclaimer, this is general advice. Sorry, this is a general presentation only. It's not property advice. If you want specific property advice, please reach out to your advisor. Most people know who I am, so I don't really want to go into too much detail there. Some exciting news. We have been innovating with our technology, and we are now at a point where we can release our research digitally, and soon, and also new investment options digitally. There'll be a link that comes out in the coming week if you'd like to be part of that. The intention with this portal is that by Christmas we'll be we'll have instead of having the fact finds that your advisor catches up with you on a weekly basis, an annual basis rather, we will operate out of the portal. Paul, there's a bit of feedback, mate. Are you on mute at your end? Thanks. Yeah, sorry, I had a bit of an echo. So on an annual basis, we've been catching up with all our clients and operating out of a Google workbook. The plan is to migrate everyone into this portal and have a much better experience for all parties when you come in for your annual meeting, so we can track your portfolio more accurately with a few live feeds coming in from various other APIs. So we're pretty excited about that, and we'll be talking more about that over the course of the next 12 months. This is a little sneak peek as to what it looks like, the visual. Moving into our strategy. So this is a new slide that we've created that represents our client journey from start to finish. And as most of you know, if you're existing clients, we start out with a growth focus. We start out with residential property. We use the growth in assets to pay off principal place of residence debt. Then typically we're upgrading principal place of residence. Then we also will engage in more growth products to pay off that principal place of residence. And then we talk about wealth creation. So this is a good slide that just better illustrates the client journey, and no doubt you'll probably identify where you are in the context of that journey. Within the strategy, what we have, and some of this terminology has been developing and we've been innovating with it over the last 10 years, but within the strategy, we have types of assets or types of strategies. So we have what we call foundation assets, and we have trading assets. So foundation assets are assets that we will buy with the intent to never sell. And typically these are, a couple of growth assets and a couple of income-based assets. It's all about buying quality. It's all about holding long-term. It's all about never selling. It's all about getting those entities right before you buy. And then we also have trading assets. Trading assets are what we've done for most clients that are in the debt reduction strategy. Trading assets are assets that we buy with the intent to sell, to then use those net proceeds to pay off either principal place of residence debt or investment debt more generally. Most of the properties we've bought in Perth, for instance, are trading, and most of the assets that we've bought in other markets, such as Adelaide or Brisbane, could be foundation or trading. So just check in with that terminology with your advisor. And again, what we're trying to do is tighten our dialogue so that all stakeholders can be clear on what we're doing for the coming 12 months, and then it's aligned with your strategy, and we're going to get the most effective outcome given your circumstances. So this is, that if you've got any questions on this, I'm more than happy to answer those questions at the end. We'll now move into our research and what's happening at the moment. So what we're seeing at the moment is a lot of the resource-based towns at the bottom of the clock. So these are predominantly trading towns. We buy to sell, we don't buy to hold, and that's because these markets are very cyclical. So most people will be familiar with that story if you bought with us recently. Perth is where most of that investment is going, not all of it, but most of that investment. We've bought 1,000 properties in Perth. We still think the market has at least 50% to run, but could run up to 100%. The fundamentals are incredibly strong. They're not building enough. The population going over there is strong. The vacancy rate is already sub 1%, and I'll get into that in a little bit. Brisbane and Adelaide, we have bought many properties in Brisbane and Adelaide, and there's many clients that have come along with that journey. We think those markets will probably be approaching a peak in 2025, 2026, 2027. It's forecasting, you're always going to be wrong, and it's highly dependent on what happens with interest rates, and we'll sort of talk about that throughout the course of the presentation, and I'll go into any market that anyone wants to go into in question time. We've also innovated the way that we display our market forecast. So this was historically what we used for 8 years to communicate externally where we thought the markets were. The challenge with this graph is it didn't demonstrate how much a market was in demand. I can move the widget. Yes, Pete, I'll do that for you. I'll get rid of it. There we go. If I get rid of the widget, I can't see the comments. That's the issue. Paul, maybe help me out there. If there's a comment, Paul, perhaps you can come off mute and let me know. This is a different way we are now displaying markets. We're looking at how much demand is in a market currently, and we look at how much runway the market has to go based on debt service and also a combination of debt service replacement cost. And what we're trying to find, particularly with our trading strategy, is markets that have high demand and long runway. That's the golden ticket when we're trying to buy a property for a medium-term profit. With this concept in mind, this is where all the markets are with respect to houses. And zero here, if a property is below zero here, it means supply exceeds demand. So currently supply exceeds demand in Orange, Launceston, Geelong and Ballarat. And we're seeing those markets come off and be very soft at the market, at the moment, rather. And then everything above zero here is demand exceeds supply. And the further you get up this chart, the more intense that demand is. And once you get into this demand score of between 40 and 60, you have double-digit rental growth, you have double-digit price growth, and we're certainly seeing that in some markets. What we have here is how far a market can run. So the best place that you want to be is right up in this corner here. And what we're saying is Mackay is heavily in demand at the moment and has capacity to run 100%. Now, there's a lot of assumptions that go into this. So again, forecasting, you're always going to be wrong. It's just a matter of by how much, but it's a really good guide as to how we're going to place clients' money in the next 12, 24 months. And it's also a really good guide as to when we should be taking profits for clients in the next 12 to 24 months. And you'll have those conversations one-on-one with your advisor. This is the demand versus runway for units. So you can see that there is far greater runway for units. Units come out to 175, 150, whereas houses only go up to 100. All right, so we're thinking that units probably have a lot further to run this cycle than houses. And we haven't historically bought units, but because we've really doubled down on the concept of trading to pay off debt, we are now open to all asset types that have a strong medium-term story, because we're getting in, we're getting out, and then obviously we're taking that debt off the balance sheet. We're using those profits to pay down debt, and it's a useful tool when building a property strategy. So the big change here is we still do the clock, but we're now moving to more of a digital way of looking at things and integrating not just cyclical movements, but also trying to get a visual on how far a market has to run and how in demand it is at the moment. This is a graph that we always like to show, because in May 2020 it was the height of the COVID crisis, and it was published that markets may fall 20%, 40%, I think, with some of the extreme calls. And here we are 4 years later, and this is what the markets have actually done. So there's been some really strong performing markets since COVID. We've been in Adelaide, we've been in Brisbane, we've been in Perth mostly, and all those bets have paid off for our clients. In terms of the macro story, so it's a very clean story. What we are seeing nationally, not just in the capital cities, is vacancy rates falling, and they have been falling for the better part of 5 years. That is due to, at a very basic level, too many people and not enough bedrooms. Too many people coming in, or too many people being born and not enough bedrooms being built. That problem of not enough bedrooms being built persists today. The governments are running around in circles trying to find solutions. They're well below their $1.2 million target over 5 years. I think they're somewhere between, depending on the reports, 60 to 80% into that annual target. So we are not building enough houses. And when we look at our forward-looking vacancy rate and rental forecasting, which is a new tool that our research department has been innovating on in the last 12 months, it shows, double-digit. It shows vacancy rates continuing to fall in a large number of areas across the country, and correspondingly, what that will mean will be double-digit rental growth, most likely for 2 or 3 years in a row, guaranteed, unless something changes, like they slow down immigration or that something miraculous happens to the speed at which we can construct bedrooms. This is the dwelling approvals. As you can see, since 2021, declining number of dwelling approvals, both units and houses all over the country. So the vacancy rate problem is only set to get worse because of underbuilding, and the underbuilding doesn't yet have a solution, which bodes well for property investors who choose the right markets, because you're going to have rental growth, and in some cases rapid rental growth, and that will move through to price growth, especially if the cash rate starts coming off. So what we've got here is migration, which is the other side of, not enough bedrooms, a lot of people coming in. We had record numbers of overseas migration. You can see it here. 547,000 people came in 2023, which was a record by some distance. And then the previous year was also a record of 408. This is making up for the lag of 2020 and 2021. We usually get 200 a year, so 200 and 200 would have been 800,000. And instead of getting 800,000 over 4 years, we got 950,000 in 2 years. So that's put incredible pressure on the rental market, and it's putting incredible pressure on the vacancy rate, and we're seeing that play out at the moment, with most markets experiencing very strong rental growth in the last 4 years. I'll start with Perth. Obviously, it is a very hot topic at the moment because prices are moving so rapidly. We'll get into the story. So 43% of the average wage in Perth goes to the average new mortgage. That has been rapidly accelerating because you've had rapidly rising interest rates and because you've had rapidly rising prices. So the affordability index for first-time viewers is the percentage of the average wage that goes into the average new mortgage. It is calculated using the average weekly earnings, the current median house price, with a mortgage of with an LVR of 80% and the current interest rate, and it measures the principal and interest repayments, assuming an LVR of 80%. So at the moment, 43% of a new mortgage, so the 43% of the average wage would go to the average new mortgage. Now, Perth has historically peaked out at 59, 55. One of the things you've got to remember with this stat is that interest rates are set to come off, and come off quite quickly. 100 basis point cuts next year is what the market's pricing in. So that will see prices will rise, but the interest rate will come off, and this number might stay the same, but you could see 20% growth in prices. Price to income ratio. So Perth all-time highs was 7.7. At the moment, it's 6.8 for houses and 4.6 for units. We don't see this as a major concern. When you look at Sydney, for example, this number is 14. So, when you compare it to the other capital cities, this is still a fairly modest debt to income ratio. What this graph tells me is Perth is moving to a point where it's unaffordable. However, interest rate movements will probably give it a bit more runway. What this graph tells me is it's harder to save a deposit than what it used to be, but it's still very much within reach for first home buyers. Okay, so Perth median house price. This is the Perth median house price since 2018, 2019. You can see it's gone from 500 to 745. For those who are existing clients, we're going to Perth 2018, 2019. So right at the bottom here, and those clients who were brave and got in early have obviously done very, very well. And in fact, most people have done well, and they'll continue to do well because the forward-looking story is very positive. About 12 months ago, we started to buy units in Perth, which was 2022, and you can see again the strong uptick in prices since we got in. So our calls to date have been right. I think the hard thing is when we sort of advise clients to start taking profits, which will be dealt with individually with every client depending on their circumstances. But I think 2025 is going to be a great year for Perth, and then 2026 we'll start to think about perhaps when we might take some of these profits off the table. When you look at the Perth median house price versus the median unit price, you can see it's at its lowest relationship to history. So usually Perth units are 81% of Perth houses. At the moment, Perth units are 69% of Perth houses. And what that told us back in 2023 when we're looking at this was probably a good time to actually pick up some units on a trading strategy, which we have for budgets sort of between that 500 to 700 mark. Household lending. So lending is the leading indicator of price growth. Most markets had this really strong bump post-COVID, but Perth is now enjoying sort of another rise in lending post-2022. So that gives us confidence that 2025 will be a strong year because those who are buying in 2025 are getting financed now. Even if they're getting financed now, they might not get into January, February, March. They might get in November, December. But this tells us that the next 12 months in Perth should be really strong. The other thing that tells us that things should be really strong in Perth is there's nothing to buy. You got record number of properties. When I say record, I mean record low number of properties for sale. That is causing properties to sell quickly. And as you can see, when we got in 2019, properties were taking 52 days to sell. Now they're taking 9 days to sell. When we got in 2019, there was 21,000 properties for sale, and now there's 13,000 properties for sale. This number is also misleading because in Perth, when a property sells, they still leave it on realestate.com for some time and it's not taken off. So this is artificially high. I don't have any of the Perth team. If the Perth team could comment, that would be great. But I think this number is closer to 8,000 at the moment, active listings for sale. And lastly, this is the change in rents in Perth since 2019 from 439 to 784. That's a function of demand exceeding supply, people competing for bedrooms, driving rental prices up. And this is also what's been driving prices up. It's just that demand, supply, and balance. So overall, we still really like Perth as a market. We're going to continue to buy there for some time. We don't have an end date on it yet. And from here, we think it's got at least 50% to run, but maybe if the right conditions present themselves, 100% to run. All right, so we'll get into Sydney. Sydney is also a very interesting market because Sydney is experiencing affordability issues that it's never experienced. So 89% of the average wage goes to the average new mortgage in Sydney. If you go back to Perth, that was in the 40s. So Sydney is very unaffordable. And typically when Sydney gets above an affordability index of 60, prices come off. So the black lines here are the affordability index, and the blue line here is the year-on-year price change. And you can see when Sydney gets above 60, prices come off. I did it in 1989, 1990, did it in 2004, did it in 2008, did it again in 2012. I did it again in 2018, and now we're not above 60, we're in the 80s. So the view we have for Sydney is that it will really struggle to grow. It's not to say it can't grow and it won't grow, but from an affordability perspective, it's challenged. Equally, to save a deposit in Sydney is very difficult. It's the average house price is 14 times the average wage. And it makes it incredibly hard for anyone in Sydney who's not getting intergenerational wealth transfer to actually get into the market. So again, that should produce some pretty serious headwinds. And Sydney, has done incredibly well for those that were invested. When we first started the business back in 2012, we did have a number of positions in Sydney, and they have done incredibly well. But we are sort of looking at this as a market that is arguably due to go into some form of correction. The challenge with it going into a correction at the moment is simply that it is still very undersupplied. We've seen an uptick in stock very recently, so 26,000 listings to 33,000 listings. Property still taking a month to sell, but the demand still exceeds supply in Sydney because Sydney gets a heap of overseas migration. Rents have been going through the roof in Sydney, so you can tell it's got this really chronic undersupply issue. Rents up 80-90%. So if you have to summarize that market, demand exceeds supply, but it's chronically unaffordable. So what happens? People have the option to buy an apartment people have the option to rent a house, rent an apartment, or people have the option to leave. And I think all of those things will happen. But from an investor standpoint, we're sort of more looking at taking profits rather than looking at Sydney houses as the next opportunity. Sydney units, however, if you look at Sydney units, they are still modestly priced. They haven't had a lot of price growth since 2016. So Sydney units may be forming a low, and we're tracking that. We don't have an open position on Sydney units, but it is certainly something to watch. And I'll take questions on Sydney at the end. Melbourne. Okay, so Melbourne is a very interesting story at the moment. Obviously, everyone in Victoria is investing outside of Victoria, and everyone outside of Victoria is investing outside of Victoria. So we're not getting a lot of inbound investment activity. That is hurting confidence in this market. And at the same time, if you look at the flip side story, the fundamentals are with Melbourne because demand does exceed supply. Rents are rising, but we are suffering a crisis of affordability and sentiment. And so this is the affordability index in Melbourne. 57% of the average wage goes to the average new mortgage. So it is by definition unaffordable because this is pretty much as high as it gets. That's a function of high interest rates, really. When we look at interest rates, when they come off, we do see some upside for Melbourne. To save a deposit is definitely way easier than Sydney. So, 9 times the average income, you can save a deposit here. It is possible, but hard. It's not like Sydney where it's 14 times, but, if you look on the flip side of Perth's only 7 times. Melbourne has done, Melbourne is one of the things that we've sort of identified in the last 24 months at an investment committee level is Melbourne is not cyclical. It had a big correction in the 90s, but then after that, it's kind of just wormed its way up with all these little mini corrections. And so what's happened at the moment since 2020, we had that bump in 2020 and now it's just gone into a bit of a correction. So we are definitely looking at Melbourne as the next opportunity, not from a trading perspective, but from a foundation asset perspective. We think that Melbourne is forming a low. And the reason why we're forming that view is primarily because when you look at rents are up 50%. So demand does exceed supply, but prices aren't going up. And that doesn't usually happen. Usually if rents are going up, prices are going up. So why is that occurring? It's because negative sentiment around our public debt, the way the state is run at the moment, and also the fact that we're not getting any inbound investment from any other investors because our negative gearing rates are probably the highest in the country with all the relevant land taxes and more onerous conditions that we have down here to rent out our property. So all those things equal opportunity in our minds in the sense that, we're thinking that Melbourne is probably going to soften a little bit further, and this next 18 months could present a low and could present great buying opportunities on anticipation of a rate cut. And with the view of buying that asset and holding that asset long term, not buying that asset and trading in 5 years. It's more of a buying in on a low, buy a quality asset, hold it long term, have it there as a long termer in your portfolio. Job vacancies have come off in Melbourne, which is the lead indicator of population growth, still very much up from 2020. This is very common across the country. We had this massive spike and then that's eased. It's still on a positive trend if you take the 2020, but it's definitely come off. I'll take questions on Melbourne at the end because I know there might be a couple, especially with people looking to upgrade. Brisbane. Okay, so Brisbane is a market that we probably bought somewhere around 800 properties in. It is currently unaffordable. That is evidenced by, the affordability index being at 57. It's evidenced by, the price to income ratio at 9. Brisbane usually doesn't get this high. It is that high at the moment. And obviously it's had a great run. So for those of you that are familiar with our business, we got into Brisbane 2013, 14, 15, 16. We bought all through this period. The fundamentals were really good and then the market has really kicked recently. So Brisbane is a market that we're buying selectively long-term for people that want foundation assets. There's still a little bit of value there, but certainly a market that we're also thinking about taking profits for a number of our clients who have been in there for some time. It's been a really good market for us, especially in the last 12 months. We've seen, if you go and have a look at rental growth, we've seen rents up 50%. So landlords have been getting more income. Landlords have been receiving double-digit price growth year on year. But the market, on our forecast, we have 30% runway left. So we're optimistic that we'll get somewhere around that, maybe a bit more than that. But the fundamentals are still good. With respect to Stockholm markets, so Stockholm markets at 18,000, downward trend, almost at a low. Days on market are 18. I would say the Brisbane market is rising anywhere from 5 to 15%, depending on the suburb. And of course, rapidly rising rents mean that there's not enough property to go around. And with the migration flows into Southeast Queensland, that story is set to continue. Okay, Townsville. Now, Townsville is an interesting one. We are buying property selectively in Central Queensland, and we're doing that because these markets are showing value and the story is really good. And we are buying mostly trading properties in these areas. So I just wanted to walk you through some of the rationale as to why we're doing that. I've got a couple of minutes left before we open up for questions. So 30% of the average wage goes to the average new mortgage. So it's the most affordable of all the markets that we've put forward today. Price to income. So, the average house price is 5 times the average income. So it's the most affordable from I need to save a deposit point of view, and I need to get into the market point of view. And I'm a first home buyer. Can I afford it? The answer would be yes. Townsville, not dissimilar to Perth, had an incredibly long stagnation. So from 07, 08, all the way through to effectively 2020s when the market turned. And so it looks like, it's experienced this rapid, amazing growth, but there's still a lot of growth to come. The median house price is, edging up towards 500 now, median unit price edging up towards 300. We still think there's a lot of opportunity in this market, as do we think this story is the same for Mackay, this story is the same for Gladstone, this story is the same with Rockhampton to a lesser degree. So, but you can clearly see by contrast to the capital cities that these markets are more affordable, they're more accessible from a price point perspective. When you look at units in Townsville, they're at their lowest point in terms of the relationship. So 63% of the average unit price. So Townsville units are valued at 63% of the average house price, and usually it sits at 87%. So houses are showing value, units are showing value. Days on market is getting lower, stock on market is getting lower. All these things are adding up to a pretty strong run. I don't think the question is there a run happening? There's clearly a run happening. It's just when is it going to stop? And that's what the research department, his job is to find out, when should we, if we're getting into these markets, when should we get out? And we're working on that as we speak. And then when you look at the demand supply fundamentals, rents have gone from 300 up to 600. So they've doubled in, 7-8 years. So there's no question that demand exceeds supply, and people that get into these markets should do really well. All right. Now, just to give everyone some insight into how we're negotiating at the moment. So there are markets that are flat, and there's markets that are on the run. So Melbourne, Bendigo, Ballarat, we're still buying in these markets. We're not that active, but we are buying foundation assets in these markets. So properties that people intend to never sell and use as a cornerstone of their property portfolios, we're still buying. We're buying those properties at market value. Those markets are flat. When we move into Rockhampton, Brisbane, Adelaide, Townsville, those markets are on the run. They're not super aggressive, but we're giving discretion to our investment consultants on the ground to bid up 5% of market value. And then when we move into, the very aggressive, strongly moving markets at the moment, our buyer agents have the discretion to spend 5 to 15% above market value. So that is set by the investment committee, these ranges based on the data. And the purpose of doing this is so that we can ensure that when we hand over a brief to the investment consultants on the ground, or the buyer agents as they're otherwise known, that they can actually transact. Because what we don't want to have is a situation where we're missing out 5, 6, 7, 8 times and the market run is 5%. Certainly that's the reality for some of these markets at the moment. They are moving on a monthly basis. Okay, questions. Hopefully I haven't bored you all to death and it's made sense. I'm on time. Paul, has there been any questions?
Yeah, I'm just looking at that. Nothing in the chat as of yet. people either want to put their question in the chat or feel free to maybe even just ask if you want to come off mute.
No questions. That could either be a very good presentation, Paul, or a very bad one.
Well, we've got it on record. We'll be able to do a full assessment later. But listen, what we will do is, as always, we will send a copy of the recording out to everyone in an email. And as David mentioned, you'll also get a copy of or a link to the new portal over the next. We're aiming at over the next week. We're just finalising a couple of things with getting those sent out to the clients. So keep an eye out for, as I said, the recording, email, as well as that link to the portal. And yeah, we do actually have, here we go. So Justin has just asked.
Yeah, well, Scott's got a question.
Oh, sorry, here we go. Yeah, Scott, first of all, so Geelong, Ballarat, how long do you see the demand side being lower than supply?
Yeah. Yeah, so look, I think that's really hard to answer that question. We are certainly looking at Geelong as maybe a market that we might be swinging back to 2025. Depends on, like, if I had the Geelong research report here, what you'd see is the median price has come off, 10% in Geelong, which means that there's isolated cases of the market coming off much, much, much further. I would answer them separately. I think that both of these markets, Geelong and Ballarat, things can change quickly if Melbourne rises in price quite dramatically. Because when Melbourne becomes affordable, the regional Victorian markets, the more unaffordable Melbourne comes, the better the Victorian regional markets do. So things can change quickly. Scott, I could send you both research reports so we can have a look at the extent of the oversupply. But I think the thing to keep in mind about Ballarat, Bendigo, and Geelong is these are great markets to buy in long term because they're not that cyclical and they kind of edge up, 3%, 5%, 8% every year. So maybe we can have a chat one-on-one on that, mate. But Geelong especially is forming an opportunity, but they represent good buying because of the underlying strategy, which is buy, hold, never sell.
Justin, David, maybe just to add just a little bit to that, as people can probably see, like we're at the early stages with this type of chart, and what you're looking at right now is a point in time, I guess, view of each of those markets. What we are working on is tracking that over time to actually identify some trends. So one thing that we would like to be able to do is over a period of 6 months actually view the direction that Geelong, Ballarat, or every market is heading in. And that should be able to allow us to maybe look at if it's moving out of undersupply into oversupply or vice versa over time. So we're hoping to get this chart to become more dynamic, which might also go away to answering that question in the future for Scott. Yeah,
but the real cause and effect for the Victorian regionals is Melbourne being affordable or unaffordable. That's what drives. Yeah. That's what drives these markets, is its relationship to Melbourne. All right, so Justin, what indicators will you be looking at in terms of timing to exit Perth? It's a great question. So, and I think it dovetails in exactly with what Paul said regarding, watching what happens with demand scores in Perth. So we want to be ahead of the market with respect to exiting Perth. We don't want to be trying to sell, hundreds of assets at the top of the cycle because there won't be buyers there. The top of the cycle is actually a mirage. It doesn't really exist. The reason why it's the top of it is because it's the last aggressive buyer and the last, seller hopeful for a high price, and then all of a sudden the market sort of resets a little bit. So the idea with trading is to take an amount of growth, about 60% or more, and then move on. And not try and achieve the optimum outcome you can get, because you might mistime it and end up on the other side, and might take 6 months to sell, for example. In terms of what we're looking for, we're looking at this demand score, and we're looking at innovating as much as we can this demand score, so that it can be a leading indicator of when the demand is starting to come out of the market, but we can still tip in hundreds and hundreds of properties so that we can still take our positions out. It's something that we've been innovating on for 3 years. And, I think the good news is we've got a bit of time, because we don't see the market peaking until 2026. And I think depending on client circumstances, we might be taking some positions away in 2025. But we might even talk about that in the next presentation around how we're showing that demand come up and down and the leading indicators of when to sell. And by the way, Justin, it's never going to be an exact science, because demand can come out of the market quickly. For example, if you have a 100 basis point increase to interest rates for reasons we don't understand. So, with these things, these are big investments, big profits. You are playing with fire. The main guidance is around taking that 60% and being happy with that. And if we can get a bit more, fantastic. Okay, so Grey Real Estate, thanks for the presentation. With Brisbane, you mentioned 30% runway left. What does that mean in terms of timing months? Again, so Brisbane is here. You can see it. I'm sharing the graph at the moment. There's about 25, 50, so that puts it 30, 40%. It does depend. The timing really, what really will move the market is sentiment and interest rates. So there's already commentary at the moment that interest rates are going to be cut next year. The market's pricing a 100 basis point cut. If that happens really quickly, things can happen quickly. That 30% could happen in Brisbane in the next 6 months, and all of a sudden, we've got a sell rating in 2025. But I do think that the interest rates will be cut slowly, and we'll have time to unload the positions that want to be unloaded 2025 and 2026. It could be as quickly as 6 months, or it could be as long as 3 years. Grey Real Estate, I don't have your actual name. Paul, is that you, Paul, or a different Paul?
A different Paul.
A different Paul. Would it be a good time to buy a house in Melbourne? Well, again, without giving specific advice, Melbourne is entering into a low, it looks like. We're pretty firm on that. It is a good time to buy a principal place in Melbourne if you can comfortably afford the debt and see yourself in that home for 10 years. Because you don't want to lose control of the debt, and you don't want to buy a house that you've got to trade out of in 2 or 3 years because it doesn't suit your circumstances. But without giving advice, Melbourne's forming a low. It could be a good time for you, pending review of your circumstances. Kevin, great presentation, lots to absorb. Okay, Peter, do you have any detail around spot areas of Perth and Melbourne to target? That's our secret sauce, Pete. So you would have to reach out to one of our advisors on that one. And the last one, 1977 is the person that asked the question. What price range properties in Perth are you seeing the best growth potential? Well, if you have a look at the runway for houses from Mr. 1977, it is a lot less than units. So units are looking like they've got 125% runway. Perth houses have around 85% runway forecast. So, it seems to us that arguably quality units at lower price points, 500, 600, 700, probably could have more to run than houses at say 1, 2, 3, 1.2, 1.3 million, because houses have already run a lot harder than units have. So without answering your question specifically, I think units have a bit more value and a bit more runway than houses in Perth. Paul, how is the southwestern suburb growth corridor in Melbourne for principal place residents? Do you provide services to evaluate this or act as a buyer agent? Paul, you might just want to take that one offline. Just email myself and I can direct you on that one. Scott White, all good. And then is Rockingham and Mandurah in the same bucket as Perth? Okay, final question. Rockingham and Mandurah has done incredibly well since we've purchased down there. Most of our clients are up 50% or more. And the market's done so well that we've just stopped our buying program there. So we still think the market will do really well, but it's kind of got, as you can see here, it's got 60% forecast runway. So we've just stopped active positions in that market. If you got in the last 6 months, I still think you do very well, but we're not creating new positions in that market. I think that might be it, Paul.
Okay, very good. Well, thanks, David, and thanks to everyone who attended. I think we'll wrap it up there, and we'll get the link out when it's ready.
Thanks, guys. See you.
Okay, thank you. See you.